Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's May 10th, and I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. So I have this huge carnival/fair that takes place every year in my small town in northern Florida. It's pretty cool. And it's a real big deal. And people travel from other states to attend it. It's called the Shrimp Festival. It takes place first week of May every year. Of course, there's shrimp everywhere. I mean, any type of shrimp, including every one that guy from Forrest Gump mentioned, can be bought at this festival. Everything. It's kind of crazy. It's also very big in arts and crafts. Some of the paintings can fetch over $5,000. Which, by the way, if you ever spend more than $2,000 on any painting, there's really just one thing you need to know. And this is if you're buying the painting as an investment. If you love it and you're like, this is great, it's fine. But if you're buying it as an investment, there's only one thing that you need to know before you buy something like that. It's when that artist is going to die. I'm not being mean here. It's just a fact. You can go back in history. Van Gogh, Monet didn't sell a painting when they were alive. Yet their paintings are, almost priceless today. Pollock's paintings skyrocketed after his death. I can go on and on here. I mean, if you're into collectibles, I know a lot of successful people in this industry, they always tell you you have to buy rare items as investments. Items that can't be reproduced. So in other words, don't buy a signed, I guess LeBron James, we'll use him as an example, right? Because he's killing the playoffs. He had a great year. Most famous player in basketball right now, one of the best ever. You don't want to buy a signed LeBron James jersey as an investment because he could literally sign hundreds of thousands of jerseys after that, as long as he's alive. And if, God forbid, because I'm a huge LeBron James fan and he's been incredible in the playoffs throughout his career and everything, having a fantastic year. If he was to pass away, then he obviously can't sign any more jerseys, right? So the value of those jerseys are going to go up tremendously. So if you go to these art festivals, I mean, listen, I'm talking from an investment purpose. I know if you're artists out there, you're going to email me and say, Frank, that's messed up. I'm just telling you from an investment purpose. But if you go to these festivals, you see a painting for over $2,000, you know what? Talk to the person. Ask them how old they are. Are they smoking cigarettes? Do you get the feeling the person may not be that healthy? You could tell these days, right? If someone's not really. Because buying a painting before someone dies, or just before someone dies. Again, I know this sounds terrible, but it's almost like investing in Apple the day they launched their first iPhone 10 years ago. I mean, it's gold, especially if those paintings are good and they got a lot of recognition. But that's how it is in that type of industry. So if you're an artist, please don't get offended. I'm just saying, if you're great, getting amazing feedback on your pieces from top sources out there, maybe you want to fake your death, change your name, probably make a ton of money. Just saying. Just saying, as an investment. I'm your friend. I like you. Don't get all over me. Anyway, the Shrimp Festival is getting bigger and bigger these days for small towns, like tons of people, and there's more tents than ever. And like I said, some of the artwork is really impressive. It's nice. But this year, it kind of took a major step down for some reason. I mean, there were people selling like their garbage. I would say like rusty nails for like 50 cents. It's like they dumped all their garbage from the garage for the past 10 years. And just threw it on old tables with price tags on it. And I saw, I'm not kidding here, because I took a picture of it, almost posted on Twitter, just thought it wasn't a good idea. But it was a fire pit. Basically a metal bowl that was rusted. Next to about 10 other big fire pits these people were trying to sell that were all rusted. And the one I saw wasn't even that big, had a price tag of $350. $350. I had to take a picture. I said, no way. And the guy's like, oh, you taking a picture? You like it? I'm like, no. I mean, I had to be honest with him. I was like, it's a rusted bowl. I mean, really, if the person said, Frank, you know what? You've done so many things for the community. You're a nice guy. You can have it for free. I would have said, I don't want it. I mean, we got rust all over my car if I took it home. $350. It was crazy. I mean, the junk in some of these tents, it was like old spoons and forks and dirty kitchen plates. I'm not kidding. But they're next to booths with beautiful paintings that was selling anywhere from a few $100s to $10,000. Told you, sometimes like a Twilight Zone down here, a little weird. And it's like, You can say it's like going to a prestigious car show where you're looking at old Ferraris and all these old beautiful cars, and all of a sudden, like in the middle of it is an old Honda Civic that's 15 years old with a dent in the door and a broken window. You're like, what is this car doing here? And there was a lot of those this year. Surprising. But anyway, the festival, pretty cool since they have a lot of stuff. The kids, they have rides, just crafts, nice firework display on the first day, along with a really cool parade, live music. And since my town is known as the home of the Pirates, the high school team is named the Pirates as well. It's very, very big. You have a ton of people that dress up as pirates, and they go all out. Like, these people really look forward to the Shrimp Fest, kind of like I look forward to the Super Bowl. Like, it's the greatest day in the world, especially when the Eagles win. But they really get dressed up and painted faces and patches on their eyes. I mean, the whole entire thing. And the kids really love it. It was a great weekend. Got to spend some quality time with my family because running your own shop requires a lot of hours. Anyone out there I'm talking to, I'm preaching to the choir, owns their own business. Sometimes that eats into family time, which I try to avoid at all costs, especially my daughters are at the age where you're cool to hang out with, fun, 7 and 10. Plus, I'm heading to New York this week on business. We have tons of meetings set up, including with one person who's really kind of a pain in my ass. You may know him as Michael Alkin. And I'm just kidding. Michael Alkin's a great friend. Price money flow trader, but we're discussing several things. I mean, he's got great contacts in the hedge funds industries and high net worth individuals and things. And we're just discussing different ideas on how to grow Curzio research from not just a newsletter publisher into something maybe much bigger years from now, like long-term plans and stuff. I'll share some of those ideas with you in the future. It's really cool. Some really important meetings set up in my hometown. So I always like traveling to New York. I want to make sure I got some quality time in with the family in there, right? Spend some time at the festival, which is awesome. Now, since I'm traveling this week, I have to keep this podcast a little shorter than normal. So I'm not going to have an educational segment. Again, boots on the ground guy. My apologies. I try to give you as much as I can. But in order to get you the good stories, good stock picks, I have to get out there, talk to my sources, and that's what I do. So no educational segment this week. However, of course, I put together a really, really awesome interview for you. As I'm never going to leave you hanging. Not doing a podcast for a week. Take pride in that. I'm doing it for over 10 years. Even when I'm traveling around the world, business, everything. But my interview today is with Jeff Phillips, president of Global Market Development, one of the best investors you'll find in the mining industry. Jeff's a no-nonsense guy, tells it like it is, an honest source in an industry where there's not a lot of credible people in it. There's a lot of people just looking to make a quick buck. It's a crazy industry, guys. Be very, very careful. But he's someone to help me understand this crazy industry and the important metrics, which you're going to cover in a minute, that you really need to look at before investing in any junior miner. You also got to introduce me to some big executives in the industry. Just a really, really great source for me, along with guys like Marin Katusa, Rick Rule, help me navigate this crazy, again, very shady industry. A lot of moving parts over the past 10 years. You listen to the right people. Jeff has also shared some private placements. My Curzio Venture Opportunity subscribers, those are my credit investors who are able to invest in a few junior miners. We're also receiving long-dated warrants. You have to know the right people to get into the right deals. It's important because everybody's looking to raise money, right? So I could throw millions of deals in front of my subscribers, but I'm very select because in the end, you want to make money for people and invest in the right deals. And Jeff's one of those guys that helped me out with that. So again, Jeff is an investor in mining companies. Been incredibly successful the past 25 years. There's big stakes. Just about every idea is going to tell you about today. But enough of me building this guy up, because Jeff's a good friend. Let's hear from the man himself right now. Jeff Phillips, thanks so much for coming back on Wall Street Unplugged, buddy.
Thank you for having me, Frank.
Well, I think my audience is pretty familiar with you now, right? Because I've had you on the podcast plenty of times, and you're a person, if not, that focuses mostly on investing in mining stocks. As everyone knows, this has been a really, really tough industry to invest in over the past few years. I guess two questions, if you can answer both of them. The first one is, how do you compare this downturn to others? Because it seems pretty steep. And what's giving you the confidence these days that the cycle in this industry will turn, be positive, not tomorrow, but maybe over the next 6-12 months?
Yeah, Frank, I think, there's the resource market is a boom and bust type market. You have the risk of developing projects along with the risk of the underlying commodity price, whether it be copper, uranium, gold, whatever the company you're invested in is either looking for or developing. So this downturn we've had really started in 2011. Besides 2016, which you I think was probably the bottom for this downturn. You saw the stocks respond well in 2016, bounce off a bottom. They've sort of been sideways to down, in 2017 and early 2018, but still off of their highs. The underlying commodities like copper, uranium, gold, and others have appeared to have put in a bottom, in my opinion. But this downturn, really, it's lasted for 7 years. Again, it's lasted for 5 years, and I think we've hit the bottom, but it takes time for that to be realized. And so this downturn's a pretty significant downturn. The only thing I can compare it to in my 25 years in the resource space was the 97, 98 period after BRIEX. The market sort of bottomed in 02, 03, and by 04, 05, it took off, where you start seeing the reason you're invested in these resources is for the 3, 5, 10-fold returns. And you sort of saw that, maybe a couple years after the market bottomed back in the early part of the century. So I think we're in that space again now.
So Jeff, how do you, and someone's been through these boom and busts, you said, for like 25 years and have been in this market, how do you look at companies or invest in them? I mean, is it, because I know that you're a person that looks at every number, every investor involved in the company, where every share's outstanding before you invest in a company. But in the end, I mean, does it come down to people before committing capital to companies? Is it finding the right structure, making sure the asset could become a producing mine? Is it the macro environment? I'd love to hear your thoughts on that if someone's been in this industry for a long time.
It's sort of all the above, Frank. But I mean, I think the most important thing in any project, in any industry, is people. You're investing in the people to execute a business plan, and that's really, mining is no different than any other business. It's a startup and has stages you go through. So I think people is the most important thing. Obviously, the right project, the right commodity. But I have friends, and I think you and I have talked about this before, and I don't know who your listeners are. So again, some of the, just so everybody understands, the resource market's a high risk. It's like you hear about the cryptocurrencies, which have obviously done very well, or marijuana stocks. There's always, or the internet back in 1999. There's things that take off, and and the resource market's similar to that. But there's also ways to lose a lot of your money. So, since I don't know who your listeners are, the easiest way to explain the resource market I have found, because I just don't develop natural resource companies. I've been involved in real estate development, farming. I came from my early childhood, and many of my friends are big farmers. So the easiest way I think to look at it is that it'd be the same as planting different orchards, basically. I have friends and investments that, whether you're planting pecans or walnuts, which are all different commodities, or pistachios, what someone will do is they'll look for a good piece of ground where they believe the dirt is, conducive for the underlying trees that they're going to plant. Early on, you've got to buy the ground. You're taking a lot more risk because many of these crops don't produce for 5 to 10 years at their peak. They start producing. So what you're really doing in the resource market is something very similar. You're having someone say, I think this piece of dirt, I can get water to it, I can do this, I can plant the trees, the weather's going to be good, at these prices, the return when the trees mature and start producing is going to be a great investment. The resource market's very similar. I'm simplifying it, but essentially early on, and you participate in early stage financings and development projects, so it's just depends on where you're investing in one of these resource plays. So if you look at say you're looking for a gold stock, if it's early on, it's a geologist who said, look, this is why I think this piece of ground has the potential to hold a gold deposit. I need money to do the initial work, just like before you plant an orchard. And I think if this work goes well, I'll prove that I can plant the orchard. Then I'm going to need more money. Then I'm going to need more money 3 years from now to fertilize my orchard. Then I'm going to need more money to get it ready to produce. And then I'm going to start producing at a small amount. And as the trees mature, I'm going to produce more. So when I look at we'll use gold for an example. I look for, can it be a project all the way along? It could be an advanced project, like some of my gold companies I'm involved with that aren't producing, but they're very close to producing. And that's investing in something that's a pretty mature tree, to put it in the orchard terms. But I can see the return. My upside may not be as great, but again, I'm looking at a gold company in that tone to say that look, if the gold price stays where it's at 6 years from now with this production, am I going to make money? And if the answer is yes, I can make a good return on my investment. That's what I'm looking for. If I'm looking at this, whether it's an already grown orchard or it's a early stage piece of dirt, I don't want to go into it saying I think gold's going to double, and if it doubles, this will be worth something. I mean, there's tons of resource projects out there in the orchard terms that are, trees that don't produce very well, and everybody's betting that if gold doubles or triples, they'll be able to produce for a profit. Well, I don't want to do that. I want to invest in a tree that I think can produce at current prices and give me a good return. So I don't know if that helps your listeners, but I find it easy to explain to my friends that are farmers and speculate on land that way, that's sort of what you're doing. So depending on the project, you could be investing in the early stage dirt, and your return's much better if they get through the 5-7 years and prove there's a deposit there, and prove the metallurgy works, and prove that the country will let them build it, and they get all their permits. There's a huge upside being early, but there's also much more risk.
No, it's a great analogy that you explain it that way. And when I want to ask you this too, because, and you won't admit this because I know you're always a humble guy, but if you're getting behind a company, when I say get behind a company, I know you personally, that means you're investing in the company, and usually you take, sizable investments because you have conviction in it. So people know you as someone who's, an honest guy in the industry, someone who invests in just select companies. So I know there's a lot of people that come to you to see if you would invest in their company. What are some of the red flags that you see? And I don't want you to throw anybody under the bus, but what are some of the things that you see when people pitch you, other than, hey, you know what, these guys don't really have high insider holdings or anything, but since you only invest in a handful of companies, you probably see I know you see a lot more garbage than good companies, but how do you spot that? Maybe you could explain that to individual investors.
Well, again, it's pretty easy to put in terms that the two things that kill projects to me are greed and reputation. And again, I want to find people that have actually built something for shareholders before. And even when you find that, sometimes greed is taken over because people think they're better or deserve more. So again, you have to look at this, that you're going to have to, again, back to an orchard. If you're starting with dirt, you're going to have to spend a lot of money getting the dirt ready, getting the water there, buying the trees at different stages as you go along. You got to continue to have more money to do that. Mining's the same way. I mean, you start off, you drill a few holes, you find something that's interesting, you got to raise more money to drill more holes, then you got to do metallurgy. And so I really want to see the structure. And that goes a lot to reputation and if it's structured right, because I know that if they are greedy early on and they give, they sell the dirt to investors, to start the project, and they've taken a large share of shares at a very cheap price. As they move along the project, it's going to be harder to raise money, even if it's being successful. So I want to see something that's structured in the right way. I want to see management have a significant holding. But I want to also see that the management team's significant holding is reportable. Because you'll find a lot of these companies where someone will call you up, and I'm sure you've had this, Frank, where they say, we own, key investors own 20% or 25% of the company. Then I look at their financial filings, and it shows the directors and certain people, or the founder or the promoter behind it owns 8% reporting. And I say, what gives? And they say, it's owned by friendly people. Well, a lot of times these people own it in other companies that's not reporting. I don't like to see that. I want to see that the management team not only owns a big piece of the company, they're reporting it so I can see what they're doing. So their exit strategy is to, again, plant the trees, take care of them, harvest them when they come in, and that's how they're going to make their money. I don't want to see that management, has a bunch of shares that they're not reporting, that all of a sudden when the speculation gets great because they've planted the trees and the property's worth more, I'm using trees again, or an orchard, that all of a sudden their friends, which are really them, are the sellers of the stock, and it makes it hard for them to raise money for the next level. They're taking off early. The hard work is going all the way through from beginning to end, and I want to see that their benefit is that if they do that, they're going to make a lot of money. I don't want to see that they can exit before that happens and make money. So does that help?
No, that helps. That helps them enormously. I hope people got that message there. That is incredible, because you're investing in an incredibly risky sector that you're trying to take out as much risk as possible, and that's the way to do it. So I want to get to a few more things here, because it's I know we have a little bit of time constraints here, but let's talk about gold in general. I know there's another area of the market that you really like, but when I look at gold here, and this has been an argument for the past couple of years, where you're seeing few major gold discoveries, at least over the past 5 years. Like oil, the majors need to find more oil to sell to generate profits. With gold, these majors need to find more gold to sell, because eventually, they're going to mine all the gold from the top projects, which we're seeing. Do you see that as a big catalyst? Because I've heard about this for like the last 2 years, and we're not really seeing some M&A, not a lot. But do you think this is a good catalyst for junior miners, where, some of these really have high grade potential gold projects that are in pretty good position for majors to come in and say, hey, we need to start building it or taking shots here?
Absolutely, Frank. And I think you touching on the oil sector is a good example. 2.5 years ago, approximately, give or take half a year, you couldn't find anybody who wanted to buy oil at, $40. It moved off it reached the lows, and companies were in trouble, and no one was buying it. Now, I'm sure if you type in oil or oil price or go to Market Watch or this Street.com, there'll be 5 articles about oil touching $70 and going to 200, and what's this going to do? And everyone's looking to reinvest because the investment went down when the price of oil went down. So gold, hasn't seen a lot of investment for the last. They've seen a lot of investment. Again, if you look at some of the graphs and charts, you'll see that different times. At the beginning of the century, 2000 to 2008, there was a ton of money that went into exploration for commodities and gold also. However, the reward for that money that's going in is much less than it was a decade before that or a decade before that. It's getting much harder to find any commodity. It's not popping out of the ground anymore. We've used those commodities. We're having to go deeper, undercover. We're having to use new technologies, and those haven't really advanced that much. So absolutely, the mineable, since we're using gold as an example, that mineable amount is going down. So the majors are going, as they repair their balance sheets from the last bull market, they're going to start looking for assets to add. So what you are looking for are assets out there in the gold environment that, look like whatever stage they're at in the orchard planting process, that you look at it, and at current gold prices, again, it makes sense, if they keep moving it forward, that it would be a profitable project. And you will see those start to get taken out. And you're starting to see majors step back in, make strategic investments, not just in gold and other commodities. So I absolutely think that's what's going on now, since what I believe we hit a sort of a bottom in 2016. And I think over the next 2 years, we'll hit that, what I call the hockey stick, where all of a sudden everybody, just like oil or real estate or the internet, wants to jump in and is paying 3 or 4 times the price of the equity that you could have bought now, when people weren't too sure about it.
No, it definitely makes sense. And let's change tunes here because, I feel the same way on gold. And you don't know if it's going to happen a month from now, a year from now, 2 years from now. But this is something that's a serious problem for the majors. And it's just something that they're going to have to address. Now, let's turn to uranium, which may be the most depressed industry had been depressed for the longest amount of time in any industry that I know, because it's basically cyclical, right? We're not talking about like CDs, or we're not talking about just an industry that's just in a complete secular decline, like, whatever. This is something that's needed. It's used for electricity, clean source, but yet we're seeing prices kind of hover at this bottom for a very long time. And there's a lot of major changes that came up with production cuts, not only from the majors, but from the largest country in the world, who's actually much, much bigger than OPEC, if you want to compare it that way. It seems like the fundamentals are right for price to go higher, but, what do you think here? Are you bullish in uranium? You like uranium, or, what's your thoughts?
I like anything. There's always pluses and minuses and things, and the story from the bulls you hear or the bears is not completely true. I think it's somewhere in between. Obviously uranium's a hated commodity. It peaked, went from $8 a pound back in the late 90s to over $130 a pound by 2005. You went from, a dozen companies with management teams that actually knew something about uranium in the equity space to, 300, 400, 500 companies by 2005, and then the price dropped out at 130. And, like you said, I think it's probably put in at a bottom at $18 a pound or wherever that was here in the last 6 months. There's the argument with the bears that you've got, much of the people are starting to figure out the alternative fuels, whether it be the sun or wind, or, and starting to make these more investments in that, and it decreases your need for uranium use. Isn't going away. It powers 25% of our energy in the United States, I believe, something like that. And China's moving, what do they have, 20 reactors under development at this point. So, and currently it's pretty simple. Uranium, the cost to produce uranium on average, even when you factor in your OPEC of uranium, which is Kazakhstan, the cost of producing, very few, if any, can produce, maybe a couple in Kazakhstan, but at these prices, you've seen Cameco, you've seen Areva, you've seen a number of people, shut down production. Cameco at Cigar Lake. They can't make money. So again, you've got to see uranium probably in the $40 to $50 a pound range for these mines to make money and continue to operate. So, the cure for low prices is low prices. Eventually they have to come back up. So I think, again, it's a contrarian play to invest in uranium at this point. And I think it's, as long as you're patient, like planting an orchard, I think it's a great time to be doing that. Again, I think uranium will come back up. It's got to come back up to the average cost of production.
Yeah, I know. I know that they say that a lot, the cure for low price, lower prices, but it seems like, that it hasn't been a cure for a while with
Yeah, but
uranium,
as
right? I mean,
if uranium moves from 22 to $40 a pound, that's a 100% move. But
mhm.
investing in the uranium space in the equities, you're not going to see a 100% move. You're going to see some of these depressed companies that actually have pounds in the ground, move up 5-10 fold in an environment like that. So that's what you're taking on that risk. And then the resource space, and then another analogy, since I've used the orchard, I might as well use baseball, is that, again, you're not going to hit, you're not going to play a game and get a base hit every time you step up to the plate. Something's going to go wrong at some point. You're going to hit the ball in the wrong spot. So investing in resource stocks is trying to invest, to bat 300 like in baseball. One in three investments that you have, you'd like to see go up tenfold. If you put equal amounts of money in three investments and one goes up tenfold and the other two don't work out, you're doing pretty well.
You do well even if you had 10 investments and one of them go, you limit your losses
Yeah,
on
and
the
then
others.
sometimes you
But
hit a
yeah.
bull market, and even the things that aren't working out go up, and it's incredibly profitable. And again, I've told people that in a 25-year career, there's really been, a couple of years in, 3 times in that 20-year career that's helped me make my net worth. So,
Yeah, I know. That's good when you put it that way, right? I mean, just it is incredible when you do see the cycle turn in this market. The gains are enormous. And let's go to some of those stock picks now, because one of the reasons why I love having you on here and being a good friend is you always share your ideas. Can you share a couple of ideas that maybe you like in the uranium sector, which is not a lot to choose from these days, right, compared to like 10 years ago when prices were much higher, but also in the gold sector as well that, or again, I don't want you to give away anything that you can't, but I'm just curious to see what you're looking at these days.
yeah, I'm happy to share my thoughts on different companies, but again, and I'll disclose if I am a large shareholder or a consultant for them. But starting with the uranium space, obviously the company that a lot of people know is Cameco. And if you look at Cameco's chart, which I find interesting, it recently hit a new 52-week high. Obviously, way off its highs of a decade ago, but it's gone back to a 52-week high. I haven't looked at it in the last week, so I think that was a week ago. But again, it's like anything else. If you believe uranium's going higher, what spot on the risk curve do you want to be in? So buying Cameco is like buying an orchard. Again, we'll use the orchard term when the trees are already producing, and you're really that they have a good production, just like Cameco has great low cost mines, even though they can't produce at current prices. You have some great upside in a solid company that's been around for a long time, and that's going to give you some good leverage to the price of uranium. As you come down the curve, which is where my specialty is, and I don't own Cameco, but again, if someone believes in uranium and wants to have a large company, and that's the company I'd look at. As you come down, you got pounds in the ground, or you have early exploration drill results, and I have earlier stage companies such as I believe Jordan Trimble at Sky Harbor Resources. Jordan's a great young entrepreneur, younger guy in the resource space, and Sky Harbor's doing a bunch of great work and has pounds in the ground, a joint venture with Areva, so that's an interesting company to do some due diligence on. I am a shareholder. I'm not a consultant for the company. Another company that I think I sent you a press release on today before our interview is URZ Energy. That's the management team that built Uriners and sold it, for $175 million 4 or 5 years ago. Actually put an ISR project into production. That's their new company, URZ Energy. They just announced a merger with another company that was having cash problems and management problems, but they have an asset that's near-term production under permitting an ISR project. So I think that's a company to watch. I think they've done it before. They've built a company and sold it, built a mine. So URZ Energy is another interesting uranium company.
All right, it's switching tunes from uranium. What about the gold space, which I know that you're heavily invested in?
Gold's always an interesting subject because you get all kinds of different people and opinions on gold. Again, I go back to the fact that if I'm looking, I'm a believer in gold. I do believe that the world's debt levels are unsustainable, both private debt and public debt and government debt and corporate debt and student loan debt and auto debt, and I think we've had a big expansion. I think gold will do quite well, and again, over time, it's always proven to be a good store of value. But when I'm investing in a gold company at whatever stage it is in the development process, I'm looking for something that at current prices, if things go right, which is still high risk, they would be a profitable company at current prices. I do believe gold over time is going higher. So, but again, that's what I'm looking for in a gold company.
And any gold names that you wanted to share with us today?
Again, you could start with the big companies, your Agnico Eagles, your Gold Corps, and I'm not recommending these, but these are the companies that are producing gold and have had a tough time. Your Kinrosses and your Barricks and Newmonts and other commodities like Freeport with copper and gold with their mine in Indonesia. But those are the types of companies that are highly liquid and very large. That's not my specialty. I specialize in companies that are either, back to the orchard thing, that are either early stage dirt and we're going to go out and try to prove this dirt has something under it, or I like to look at things that are 4 years down the timeline in the orchard analogy where I've got trees that aren't producing. I need a few more things to happen, which is in mining terms means I have a 4310 compliant resource, hopefully a pre-feasibility or a bankable feasibility study, which is more advanced. So, but I'm looking for companies before production somewhere in that before revenue stage that I think will either be taken out by someone who needs the revenue down the road, or they can actually put something into production. And again, I tend to look for things that I hopefully get taken out, because putting something into production is very difficult and very costly. So on that note, I have different levels, but you and I have talked about a company called Revival Gold, which is a newer company in the last year, run by Hugh Agro, that's a tremendous executive and great track record, and has structured the company incredibly well. As you and I talked about, that's one of the most important things. They acquired the old Bear Track mine, which was a producing mine from Meridian, which was acquired by Yamana, which is a producing company. Yamana wasn't doing anything with the asset. They have assets around the world, and again, are like all major companies trying to fix their balance sheet after this commodity bust, so to speak. So he was able to buy that past-producing Bear Track mine, I believe. And again, I'm a large shareholder in the company, and I consult for the company. So I want you to be aware of that. But they were able to acquire that asset, and with the land they picked up around the past-producing mine, I think it's 1.4 million historic ounces. Those aren't 4301 compliant. But Revival Gold is getting ready to, there should be coming out with a resource in the next month or two, and my bet is it's going to be more than the historic resource, and it'll be compliant for exchange purposes. They are also starting an 8,500-meter drill program, and the best place to look for gold is next to a existing gold mine, and there's still a lot of ounces there. So again, I think Revival Gold, there was an excellent report by Echelon Partners, which is a brokerage firm, and an analyst came out with a report about a week ago, and it's a great report on the company. And again, I think the historic gold is being valued at $12, $13 an ounce, which is under what a lot of companies are getting valued at as they start this drilling and the new resource comes out. But that Echelon Partners report, I think you read it, is an excellent report.
No, that's great stuff. That's great stuff. So, and I appreciate it because I kind of put you on the spot there because I know you so well. Jeff, what about some gold stocks?
Yeah.
So, no, I really appreciate it. And listen, I know you said you wanted to do this and keep this to around 25, 30 minutes. So that's what I wanted to do because I can go on and ask you questions forever. But I just want to say I really appreciate you coming on. This is a risky industry. I know a lot of people have investments in here, but it's nice and refreshing to hear people say, listen, it is risky. These are how you lower your risk. This is how you lower your risk to try to maximize your returns, because it's an industry that I agree with you. It's going to turn, and we're not that far away. So, and these gains could be really extraordinary for people, I think.
Absolutely. I think we're again, we're in for a 2-year good run where, even dumb mistakes can be rewarding, and dumb mistakes over the last 6 years can cost you a lot of money. But I think you're at a spot now where, again, you should try to make smart decisions, but I think a bull market hides the dumb decisions too, and I think we're heading into that. So.
No, I definitely agree. All right. So, Jeff, thanks so much for joining us, and I'll talk to you soon, buddy.
Thanks for having me, Frank. I appreciate it.
Yeah, it's great stuff from Jeff. Love the fact that he shares his ideas, and he's very honest. He's open. He's showing you exactly what he looks at. He's a guy that tells you, which a lot of people don't in this industry. They'll just, especially if you walk through like the PDAC, which is one of the large mining conferences. He's held in Toronto. Some of these big conferences that are held that I attend. I speak at a lot of the mining events in Canada and throughout the U.S. But a lot of these companies will always tell you about their upside and how great everything is, and it's refreshing to hear when you got guys like the Curzio's and the Rick Rules and the Jeff Phillips to say these are really risky stocks. You shouldn't be going all in on them. Because as you could see, if you follow this podcast, at least for the past 3 years, in 2016, we had Marek Tusa come here and give you probably, at least that I know of, 4, 5 baggers or more. But we've seen since, I would say mid 2016, towards the end of 2016 till today, this industry has really crashed again. You see these stocks, you're like, wow, things were so good. What happened? It's a boom and bust industry. Just like Jeff said, you have to be very careful. So if you're in at the right time, this is an industry that can give you 10x times returns. As you know, if anything that I've taught you over the years is in order to get higher returns, you're going to have to take on more risks. So keep that into consideration. Because I still get emails from people like, Frank, what about NAK and what's going on? It's a stock that was up 900% for us in 7 months, right? We took half off the table, and a couple of times I said, hey, you know what? It really looks good here. It came down to, $1 and change. It came down further, so it looks good. Even saying it looks good and things like that, you should be up tremendously on this name if you listen to me and you play it right. So people asking where it is now, it's tough because you have a crappy industry that people hate to begin with, and then you have a company that you're still dealing with some of those EPA problems with NAK. So I get a lot of questions on that. But when you look at this industry and you invest in some of these names, you'll have analysts, including myself, come on. We have conviction on these stocks because we know the projects. We visit them. We go out there. We know the management teams. We know everything about them. However, it's a very tough industry. So for me, in my Curzio venture opportunities, and not giving anything away here, I have 3 mining stocks. One's down a little bit. The other 2 are down slightly. One's down more than that because we had for a while. But I want exposure to this, and I'm willing to take on those losses because there's a lot of other stocks in the portfolio doing very well. We've had several 100% winners. A lot of volatility in small cap market, especially during earnings season, which, it's getting used to, but it's a high risk, high reward product. And that's why I'm putting a lot of these mining stocks in there, because once this turns, as you saw when we were, again, I went to go visit Northern Dynasty NAK. I went to Alaska, taking 2 planes and a helicopter to go see that site for recommended stock at 35 cents. And there's McEwen in mining that we recommended under $1, it went to 4, and then it's come down. So just be aware of that industry. You're not buying IBM. You're not buying, and IBM may not be the best example, but you're not buying Apple and these big names and stuff where you'll see 10% moves max. These are companies that move everywhere. And if you're nervous about them, if you're asking questions and going crazy and say, wow, look at the moves on these, then either you have too much money in these situations or you need to be much more diversified and own like 5, 6, 7, like Jeff said. Jeff said 1 out of every 3, 1 out of every 7. You need one of those stocks. If you limit your losses, which a lot of people in the mining industry, guys, I'm not throwing anyone under the bus, but I'm going to say nobody in the mining industry, those guys are high risk, high reward players. I mean, a lot of those guys cash out when their stocks get taken over. They don't cash out when it goes higher. They don't even sell their holdings if they're insiders. It's almost, it's very negative for them for some reason. In the U.S., hey, you know what? If a stock goes higher, you're going to see a CEO with a big position in the stock start selling a few shares and diversifying. There's numerous reasons why people sell. There, nobody really, it's an all-in market. It's all or none. And you don't want to invest like that. You want to be able, which means you're going to be stopped out of a couple stocks more often than not. But these are guys that will buy like 5 situations, 10 situations and hold on to them for 5, 10 years and get destroyed because you have a market that's really been a bearish market outside of a small period in 2016 for pretty close to 6 years now, 5, 6 years. So you want to limit your losses. And if you invest in 6, 7 of these stocks and limit your losses on them, you need one hit and easily outpace 6 losers, which, you're not going to have 6 losers, maybe 2 or 3 that stop out and the other ones are down a little bit. And what Jeff said, when the market turns, every single one of those stocks are going to go higher. Just, the better names, I don't want to say more high quality names because they're not going to go up as high. Usually the gamma goes, like he said, with uranium. That's not going to go. If uranium prices double from here, you're going to see companies like Sky Harbor, URZ go up, much, much more than the bigger players. But when you have the junior miners, there's a different level between good junior miners and crappy junior miners. And the good junior miners could see 5 times, 10 times, 7 times returns just if you see the entire industry come up and turn, and that cycle turns. So that's why it's worth being invested in this industry if you do it the right way. You have to have portfolio management. A lot of people don't talk about that. They're just like, buy your stocks, hold them forever. You can get crushed if an industry like uranium or gold stays out of favor for so long, and that's what happens. But if you're invested, just, hey, here's a portion of the money. I have a few of these stocks and spread off across, other things that I'm investing in that are aggressive, whether it's technology, biotech, cryptocurrencies. You're probably doing well in some of those other ones. Cryptocurrency had a nice leg up. So did biotech, came back a little bit. But it's worth it if you have the right portfolio manager strategy. So I'm glad Jeff shared that with you. But I love Jeff. That was a great interview. But this podcast is about you, not about me. Let me know what you thought. at frank@curzioresearch.com. That's frank@curzioresearch.com. Okay, guys, be sure to check out my Curzio Research Facebook page. Usually end every time on this because we're just doing lots of great things. Not just live videos that I've been doing probably for about 4 or 5 months now, but now we improved the technology, which is amazing, where you can actually follow along with the things I'm looking at. I put a lot of free sites in there, so as I'm talking, you're looking at whatever. If it's Yahoo Finance, and I'm going over statistics, the statistic page within Yahoo Finance and showing you, what a dividend payout ratio is, or you can basically follow along. And pretty much we're going to start doing just more interviews, live interviews, which you're going to be able to see, and hopefully, very, very shortly, live podcasts. So you're going to see me do this whole entire thing in my ugly mug instead of listen to me. A lot of cool things that you find all that stuff on our Curzio Research Facebook page, including a lot of free content that we post there. So definitely check it out when you get a sec. So guys, that's it for me. Thanks so much for listening for the educational segment. Next week, back to normal. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.